going to invite my two awesome partners and friends, Dr. Kai-Fu Lee, and come on up, and then also my partners at Raise Capital, Alfred Chuang. So 2022 been a kind of crazy year, particularly for tech and ventures, the economy in general. So the Fed increased interest rate 5 times. Elizabeth Holmes now in jail. And the stock market dropped at least 80% in terms of many of the tech stock price. So my first question is going to be around, what do you guys, any prediction for 2023? Is it going to be better, worse? Any prediction just for venture and tech in general?
I think one of the things we should expect, there's a reason why interest rates went up 5 times. I think 4 of those times were 75 basis points, which is extremely aggressive. And is to try to cool asset prices and also look at employment rates. So if you look in the US economy, it's working okay, but not great.
I would not be surprised that more interest rate hike may be coming. And that obviously will affect the equity market. Alongside with that would be late stage valuation, which has come down a lot, but still expensive comparing to the public companies. So in order for, I think, this tide to shift, likely what we will see in 23 is at least in the first half is going to be, I'm going to guess it's going to be pretty tough. And we're starting to see prices of deals coming down from late all the way down to early. I will compare this to kind of the year 2000, which is very similar, because in the year 2000 we saw a large equity bubble in tech bursted, and we saw consolidation. And in 2001 we saw September 11 happen, which is kind of similar to what we've seen in the macro environment with the Ukraine war and all that. So then we saw a huge amount of innovation from that point on, all the way through consolidations and different things, and we saw the maturation of the internet. So we should probably see something very similar of this kind of things to happen as well. From that perspective, I'm actually quite optimistic of tech going forward in 23.
Okay, so first let me comment on US. One is the issuance of a huge amount of money, and that resulted in trillions of dollars, much more than is needed or appropriate due to a whole set of reasons. And that money has led to overvaluation, because when people who don't need the subsidy get the subsidy, what are they going to do? Buy stocks, right? And the third phenomenon is that I think the investment community in general always lets the pendulum swing too far. So when things look good, the price get way overvalued. When things don't look good, they get way undervalued. And we're currently on that swing, perhaps towards, but not quite at the bottom yet. That's my view on the US. May not be completely accurate. Take it with a grain of salt. My view on China is that China began the descent of its tech valuation well before the US, due to a different set of reasons. Some industries were facing trouble, antitrust issues, and uncertainties later due to different policies regarding all kinds of things. So those kind of created a lot of fear and uncertainty down in the investors' eyes. So China stock and China growth, PE, and then trickling down to early stage really happened some 9 months before the US. So in some sense, China is a little bit of a leading indicator for the US at a macro sense, because now we're seeing China, we're still seeing PE and growth in a lot of challenges, because I think a lot of money went in when the price was too high, and also the exits become very difficult, and also we say 倒挂 in Chinese, which means your price is high in the PE, but lower, the equivalent company that's public is lower. Well, who's going to invest in PE? So I think that difficulty will probably continue, because as long as this mismatch exists between primary and secondary market. However, in China, we have for some time, in our latest fund, we have been seeing the valuation come way down in seed, angel, pre-A stages already. and that's continuing. I think we're seeing companies that would have been valued 3 to 4 times higher 1.5 to 2 years ago that we saw in the last 6 months. So I think it's a tremendous opportunity to invest in deep tech, partly because I think if they're undervalued, early stage companies shouldn't be that much sensitive to the macroeconomic conditions, but they are because of people's irrational thinking, and investors should take advantage of that and capture the early stage tremendous deals that exist already in China, and according to Alfred, I think happening in the US. So I think it's the best time to invest in early stage, I think, in both countries. And of course, in China, there's also the Chinese government's need to develop technological self-sufficiency. So that's another potential factor that would make early stage tech companies attractive. But other than that, if I were investing my own money, other than early stage tech, I think I would still be watching for the pendulum to see if it will maybe go even lower before putting a lot of money in, or also watch for the situation in the growth of PE, that they're properly priced, whether it's because the stocks have gone up or because the growth PE stage prices have gone up.
If I'm a CEO, a founder, if the value is dropping, it's not really good for me as a founder, right? So I don't want lower valuation. I want to maximize, make sure that I should own enough and not give too much away. So what would be your advice for our fellow founder and CEO in the audience?
If you're a founder CEO, first and foremost is managing your cash flow, and if possible, prioritizing businesses that will deliver favorable cash flow, and deprioritizing things that will burn a lot of money, reduce your headroom or runway. Those are obvious. I think you all know that. I think also when and if you need to raise money, you need to raise money. Don't worry about whether this is potentially a down round or a flat round, or the valuation is not ideal, it's way lower than before. Well, you gotta really have that war chest in order to develop your business. So I would say these, I think, are some of the key things. And you might need to let go of some of the previous aspirations. I was talking to a company that, not even a startup, that was once worth $100 billion and now only worth $7 billion. Even this $100 billion company CEO, facing the environment that he faces, he's cutting down, product lines, withdrawing from markets that he expanded. It looks on papers like silly. You spend all this money, build it up, then you kill it. But these are the practical realities one needs to have.
Alfred, you're an early investor in Slack and Databricks, and I don't want you to comment on any valuation per se, but what are you going to do if this is what's going on now, particularly from a founder point of view?
Well, speaking from my own personal experience, so you guys are mostly too young to remember this, but US had a huge stock crash in the late 1980s. And I ended up starting a company in the late 1994 kind of time frame. And at the time, it was really not a very good time to raise money for anything. So I was originally from Hong Kong. At the time, there weren't a lot of Chinese founder starting a company in Silicon Valley. So I was given a term sheet for raising $50 million, which I thought would be all the money we'll ever need, which is actually kind of technically true because that's the only private money that we raise. But to give up 50% of the company, which nobody would do these days. But I thought it was, given all the parameters, it was the right deal. Now looking back, the company reached to, $60 billion in valuation and sold for almost $10 billion to Oracle many years later. Nobody will think that was a bad deal. So I think valuation is important, but at the end of the day, it's not that important if you were able to build a great company, because the exit would have been benefiting everybody. So I think that's one thing I would encourage everybody to think clearly about that. All of our own portfolio company at Raise Capital, I encourage, but Edith sometimes will say I take out the whip and whip all the founders and say, get yourself 18 to 24 months runway. Never get yourself to be pinned against the corner that you have to go raise money because it will be very, very painful.
All right, so I'm going to quickly switch topic to AI. It seems like particular Silicon Valley have a frenzy going on with particular generative AI, even though the deal dropped quite a bit from 18,000 to 15,000 overall. But in terms of deal count for generative AI is increasing, especially I think this couple of days, Microsoft announced they want to put 10 billion into OpenAI, which is valued at 29 billion. It seems like there's a lot of things happening, and plus ChatGPT in 5 days, 1 million users is certainly impressive. So I'm going to start with you. Kai-Fu, what do you think about that?
I think on the one hand, this is an absolute paradigm shift. I think of the old AI that we're used to, that I wrote my books and made my first, a few dozen investments on, are an AI technology that's trained to do for a single domain, large amount of data, to optimize an objective function based on a closed loop data solution. So the new approach that's being put forth, some people call it LLM, large language model, some call it foundation model, some simply refer to instantiations like ChatGPT, DALL-E, and Stable Diffusion, etc. But all of them have one thing in common, which is that it's built on the premise that AI works better with more data, and more data requires more compute. And how do you have an nearly infinite amount of data? Well, you have to get away from the old problem of labeling, because labeling is very slow, expensive, error-prone, and also domain-specific. So people have come up with new ways of teaching AI in these giant models with an infinite amount of data without really a traditional objective function. So you can think of it as AI evolving from a little autonomous unit trying to learn to do one task really well, and that's all it does, all the way now to an infinite amount of data, teaching it to have a brain, to have a memory, and to have a way to analyze and abstract information and able to do some degree of generalization and intelligent behavior. And you can still take that and fine-tune it with transfer learning into specific domains with objective functions. So you can have your cake and eat it too. So I think it's a transformative idea. Which of the ideas will win out? What are the best application areas? We don't know. So the excitement behind it, I think, is completely justified. And the other one is that the power of these generative AI is such that they will redefine industries like search engine and content creation and advertising and e-commerce, and will have all the great things about AI. It'll be targeted content to persuade, mesmerize, and maybe cause someone to be addicted to content and cause someone to buy some product by tailoring the message to that person's needs or insecurities or desires or weaknesses. So that carries all the dangers of what I would call Cambridge Analytica on steroids. And it will also have an amazing ability to create content, and including create misleading news, fake news, false advertising, slander. It can do that very quickly and accurately, convincingly, and in a targeted manner. So this is one of the externalities which I think is very difficult to deal with.
I agree, Kai-Fu. It's a very exciting time, there's no doubt. Microsoft just invested $10 billion in OpenAI. So now the amount of resources that they have will lopside how things will work out, who's going to dominate, these type of remarkable data-driven kind of application. I think there are two things I think we should probably think about more macroly. One would be how application will work, let's say, a decade from now. That's exciting stuff, right? Because if we could have predicted how the application works today and how you're using applications 10 years ago, we probably would have invested in developing things very differently than we would have done it the way that how we got there. Because I think a decade from now, we're unlikely instrumenting application the way that we're instrument, like you are today.
All right, so to summarize, it sounds like 2023 will make 2022 kind of sleepy year if you are into AI. And even though valuation is pretty bad, as long as you have 1.5 to 2 years of runway, you will survive. So that's sort of a summary of what we talked about today.